Well, hello everyone. Welcome to the Real Estate Wealth Lab, our Market Leaders Lab. And this is a very exciting evening for us. And this song, actually, it's a very unusual song. You might have thought, oh, it's a little slow to get started, but it is actually called Who Is. And tonight, ladies and gentlemen, the Who Is of the Who Is in the house. So I'm very excited. We're going to get started in just 1 minute. So we're going to have a little bit more while we're waiting for a few more people to come, and we're going to start on time. One moment.
How's my audio right now, Jen? Is it okay?
Wonderful. Welcome. Okay. We can all hear you. Fantastic. Well, it is now 7:30 and I like to get things started on time, and there's a number of you with your cameras off, and that is just perfectly fine. But feel free to get in there, show your smiley, wonderful faces so that we can actually have a really cool conversation and connect with each other, because this is going to be interactive. There's opportunities for you to get your questions answered today as well. So I'm just going to start by, can everyone see my screen? Do you see the Market Leaders Lab? Thumbs up? Wonderful. Okay, thank you. So today we have an incredible panelist, a panel of Aurelio Baglioni, Marsha Wilkinson, and AJ Hazy. I'm going to introduce them in just a moment, but before I do that, we're going to go through a couple of housekeeping items and letting you know what the Real Estate Wealth Lab is all about. First and foremost, of course, that legal disclaimer, because we're talking about real estate and sometimes we're talking about forward-looking information. Just so you know, we're not providing you full-on advice, but we are providing you information that you may want to go and research a little bit further. And there's more about that. What are we doing right now? We've got the Real Estate Wealth Lab's open house launch. So for September, October, November, and December, we're actually open for everyone to come and experience what we're all about. We're doing a free trial. So we have a full access free trial of all of our real estate wealth events, our assessments, our tools, and our intelligence, all for you. So our market leaders, so what our REWL events are, we've got Market Leaders Lab, which you're on today. You're going to get experience of that. Our community lab, as well as our research lab. And for those of you who joined on September 22nd, that was our very first launch for the research lab. And actually, just pop it in the chat. Who here was able to make that event? Awesome, wonderful. Tara, you're not late. Glad that you're here. Vincent, awesome. Cindy, it's great to see you too. It's great to see so many familiar faces. So really welcome. And yeah, so as we go along here, we've got a number of events that you can experience in October. So we had 2 events. And in November, we will have 3 events. So you'll get to experience all 3. And then in December, just because of the holidays, we're going to have 2 events. And those will be emailed out to you very shortly. So you'll have a good sense of that schedule. Now, in addition to events, we've got some other cool stuff at the Real Estate Wealth Lab. So you're going to get a full access trial to our tools and intelligence. Our tools include the investor profile and assessment, as well as a portfolio diagnosis assessment. So that's taking who you are, as well as if you're already investing, where your portfolio is, and looking at it to see where it is and what needs to be done potentially. In addition to that, near and dear to our hearts is the Real Estate Intelligence newsletter. And I only say that because as the Chief Intelligence Officer here at the Real Estate Wealth Lab, I tend to be a little geeky, and I really like to provide what it means, what those headlines are. So that is something that is only available through our free access, our trial period. And then of course, later on as members. So why join? For our free trial, you are going to basically become an automatically registered to all of our events. You're going to have the experience of what it's like to be a part of the Real Estate Wealth Lab community, our next level of investors. You will also, as I mentioned, receive that weekly real estate intelligence newsletter. And I'm highlighting it again because many of you will receive a Real Estate Wealth Lab newsletter, but unless you're signed up for the free trial, you're not going to get that sassy insights from yours truly and the rest of the research team. So you'll definitely want to check that out because it's getting uncensored, untethered, unapologetic, and definitely real. You will also have access to our members portal. And this is an archive of previous newsletters, of recorded events, and access to slides and data. So you'll definitely want to check that out. And you can become, get that free trial at realestatewealthlab.com/trial. So that's just down there in terms of the link. And our next event, you'll want to mark this on the calendar, is Wednesday, October 27th at 7:30 Eastern and 4:30 Pacific. Now, you might be getting a sense of a little theme here. So we're going to be operating as regularly as possible so that you're consistent, you get the information that you need on a consistent level. So start marking some Wednesdays at about that time for the next foreseeable future so that you don't miss a thing. And of course, we've got an amazing team. The Real Estate Wealth Lab is comprised of some really amazing next level collaborators. And I'm so delighted that all of these individuals have come together, and many more, by the way, behind the scenes to really support this initiative that's designed for next level investors. And so a huge, I see Naran, you're on the line, our Chief Leadership Officer. Vincent, you're also on the line, our Chief Technology Officer. Yan, he's here too, our Chief Marketing Officer. And thank you. And Paige Saracen, who is our Head of Customer Experience. So many of you may have experienced Paige giving you a phone call or a text and helping you get started. So Paige is a lovely lady that you'll get to talk to on a regular basis. And for those of you who don't know me, my name is Jennifer Hunt, and I am the Chief Intelligence Officer with the Real Estate Wealth Lab. And I am an international expert, investor, and most importantly, a research analyst that loves to provide you with the information that you need in order to make those smart decisions. So we would like to ask you to follow us on Instagram. So we are at the Real Estate Wealth Lab. So please join. Oh, Paige, you're there. Please wave and say hi. Sorry, I missed you. There you go. Welcome, welcome. Right on. So that was our team and some of our team. Many others working tirelessly in the background, and we're so delighted for that. Thank you for the collaboration and support, everyone, to get this off the ground and started. So we've got a couple of chat rules. Yeah, like the play on word rules. So we do want you to ask questions, say hello, engage, chat away, type it out. Please also share your feedback, your thoughts, your ideas. I know many of you have already sent messages to info@realestatewealthlab.com. You've also sent personal messages to lots of us on the team. We're hearing you, and we're being able to be super nimble and implement what you need. And today, this Market Leaders Lab is actually a reflection directly of your feedback. So I'm very excited that we're able to implement that and be nimble right away to give you what you need. We also not recommend, this is a do of our chat rules, is please be respectful, be courteous and kind. And we do have some don'ts, and those are please do not solicit or sell. And in terms of housekeeping, this is being recorded. So as a registered guest, this recording will be made available to you, but also just so you know that this is by being here that you have consented for us to video and record this. So just so you know that. Oh, pardon me. Well, I think that's everything. Yes. So let's get started. So our Market Leaders Lab, ladies and gentlemen, is really about having the thumb on the pulse of that next level investor. And proximity is power. Being close to folks who are in the conversation that you either are aspiring to be in or that you're already in, but you kind of want to just test out and compare. Are these conversations similar to the conversations that I'm having to bring my portfolio to that next level? And it's about finding those people and bringing them together and having different kinds of conversations. And so we're joined here today by many of you who are playing at that next level and some who are already that next level. And we want to be able to really bring you into the conversation so that you can kind of get a litmus test. Are you doing it right? Do you need some help? Who do you need to connect with so that you can go on your journey in the best and most efficient way? So I'd like to welcome our amazing panelists and make sure that they are spotlighted so that we can be up at the front here. So we've got Aurelio Baglioni, Marsha Wilkinson, and Adrian Hazy. AJ, you don't go by Adrian. All right, so an AJ. So hopefully they'll be highlighted. And before we begin in terms of having them introduce themselves, what I want to say about each of these amazing individuals, and I've had an opportunity to talk with them independently, is that each of them are very serious players doing super cool things in the market. And what does that real estate game at that next level, like what does it make for us? You know, what do we want to do with our own portfolios? And what each of them brings is a completely unique strategy, a completely unique approach, a completely unique perspective. However, they're all in different markets and they're all doing very different strategies, but they have a couple of common identifiers. And I think that when we talk about our next level, that these common identifiers are so important. So each of them is a next level investor. They're doing big deals with big opportunities for other investors. And I think that's a really neat perspective, and we'll talk about that, is it's not just about their own portfolios, they're helping create wealth and financial security for others. And that's a beautiful position to be coming from. As I mentioned, they each have unique approaches, and we're going to hear lots about those today. And they're also very much in off-market or distressed properties. We'll definitely dig into those distressed properties and what that means in just a moment. And welcome. Oh my gosh, it's so great to see more of you joining with your videos on. That's awesome. Welcome, welcome. We're just getting started. Kennedy, Lewis, great to see you. And so they also solve problems and they really, really help create that financial security for others. But you know what's really at the source of these wonderful next level investors? Passion. They're absolutely passionate about what they do and how they contribute. So, ladies and gentlemen, without further ado, we would love for you, I'd like to invite you, our panelists, to introduce yourselves and tell us how you invest in real estate. And Aurelio, I'd love to start with you first. Oh, and you're on mute, I think, so we got to make sure that you're unmuted.
There we go.
Wonderful. There you go. I can hear you.
Oh, I can repeat my name. I think that's as far as I got. Good pickup. My name's Aurelio Baglione, and I've been involved in the real estate industry now since 1986. That's when I sold my little pizza franchise I had, and decided that running your own pizza franchise was very, very time intensive, and there had to be an easier way. And so I started buying duplexes in Barrie, Ontario, duplexes, townhouses, that kind of thing. And then I discovered that it took just as much effort to buy at the time. 1994, I bought a plaza for 1.25 million. And it took as much time to do that deal than to buy an $80,000 duplex in Barrie. So I slowly gravitated towards the bigger commercial properties. In 93, I purchased 75 townhouses in Calgary, Alberta. And here we are today. I've got about 1,500,000 square feet. We've got 8 properties in the US now, 1 in New York, 2 in Illinois, 2 in Wisconsin, 3 in Florida, and about 30 properties here in Ontario, including 5 malls. I have a rather large team that works for me, a company, accountants, lawyer, property management, staff, on-site staff, and of course there's me. I basically just steer the ship. And recently I formed a real estate investment trust about a year and a half ago. And the reason for that was that when I started in 1986, I had pretty much zero experience, almost zero knowledge, very limited capital, very limited credit, and very, very few contacts. And so I thought, if I could get to where I am in life with starting from that, imagine what I could do if I started an entity from scratch and gave passive investors the same opportunity as I had, but without having to relearn and make all the mistakes that I did in the last 30 some odd years. We bought, just to give you an idea of our 2 buys, in April of last year, during the middle of COVID in New York State, I bought a freestanding wholesale store, BJ's Wholesale Club. They're like a Costco. They're a public company. I bought that and closed in October. We paid $7.45 for it. We just got it appraised about a month and a half ago for 8.4. And last month, I just purchased a single tenant government. It's a government tenanted building. It's our federal government here in Canada. And we paid $6.7 million for it. The cap rate is somewhere close to 12. I know if you're in real estate, you get that. It's unheard of, but it was one of those deals where it's actually a wealthy family, last commercial property in their portfolio, last property in Ontario, and they wanted it sold off market. They didn't want their name attached to it. So I got a call from a realtor. We negotiated over the course of a day and a half, and we had a deal. Most of my properties have been either foreclosure, power of sale, or receivership. And it's basically based on the premise that the deal has to find me. I'm not chasing the deal. And that's just, what we learn in university about supply and demand. So I'll get calls from my realtor friends that will tell me about, for example, the mall in Kapuskasing. Well, where's Kapuskasing? Well, I found out where Kapuskasing was. And the point is that people live there. Like, people have to live there because they have an industry. And so that's where I've been able to find a lot of my opportunities. And then you run into a situation where what's been happening here in Toronto, where you drop a pebble at Yonge and Bloor in Toronto, and the inflationary cycle starts and it just expands. And all of a sudden, you've got rents in Parry Sound that have gone up 50% in the last 2 years because people are moving out of Aurelia, because people are moving out of Barrie, because people are moving out of Vaughan. So because it gets more expensive. So that's been more of fortuitous, I would say, but the principle is based on a cash flow model that in a bad market, we can ride out the storm. And what rides out the storm is cash flow. So our cash on cash return, we started last year at a 7.5% distribution with a 4% mortgage principal reduction baked into the model. So there's about 11%, 11.5% baked into the model. Our return last year was 14.4. I'm not soliciting. What I am saying is that it is possible to achieve those numbers if you buy right. And if you don't want to be shut out of the market, then maybe it's a good idea to participate with somebody who's already in the market.
I love it, Aurelio. So thank you. And there's so many concepts in there that we're going to come back to, because I want to talk about some of the products that you have created and why you did that. And also you touched on a very important topic about markets and how you select them as well. So welcome, Aurelio. Been doing this for a long, well, not that long, but you know, since a youngin', there you are. And welcome. Marshall, why don't you tell us a little bit about how you got started and about your company and how you invest in real estate?
Sure. First of all, thanks for having me. I'm really happy to be here. I think what you guys have put together is really great and extreme value to the participants, you know, and everybody who's involved. So really excited to see what you guys roll out in the future, and looking forward to be a member and see what else you guys roll out. So thanks for having me. So my name is Marsha Wilkinson. I'm from New York, originally from Long Island. I'm a second generation construction guy, contractor, union signatory, local 25, local 3. Okay, yeah, the screen just, now I can see everybody's beautiful face.
Thank you. Yes, so we continue on, please.
Awesome. Yeah, so I've been in that business. I mean, listen, I'm a fairly young guy. I've been in that business for 40 years. I mean, I learned the construction and development business vis-a-vis osmosis at the dinner table every day. That's when families ate dinner at the table every day. That's how I grew up. And I learned about construction and dealing with contractors and developing real estate and buying it every day of my life, really. So I've been in it for a while. But investing in real estate is a little different, and it's kind of the natural progression for contractors, because construction and buying real estate, they're kind of cousins, right? If you're in the private sector, you build the thing that other people buy and they pay you to build it. So it was a natural progression for me. I have a private equity fund called Saxon Capital. The contracting company is called Eldor Contracting and Eldor Electric. It's a $100 million construction company. We dominate the New York City area, and we got into real estate as a way to own assets and lessen our tax bill at the end of the year. You know, the construction company is a revenue generating machine, and you have money at the end of the year that you need to do things with before you get distributions. And real estate was that avenue for us to diminish our tax bill and increase our assets. The type
sorry, that is next level thinking for sure, right?
Yeah.
Take notes on that one. Carry on, Marshall.
Yeah, sure. And so the real estate that I buy is very simple. It's funny, I kind of contradict myself. Being a guy who's a builder, I don't want to touch a hammer on any of my properties. So I buy diamond properties. I say that I don't want to make the Yankees, I want to buy the Yankees. And so I'm looking for cash flowing properties that are AAA diamond. I'm looking at 5 and 6 caps. I play a different type of game with family office money and family money. We look to store the money, secure it first and foremost, and look for cash flow. Like Aurelio was saying, cash flow is king. There's a lot of ways to skin the cat here and be extremely creative and juice your cash on cash returns. Like Aurelio said, 14%. That's awesome. Okay. I play a safe game. Real estate is the safe game. I have guaranteed cash flow. We own great assets, and we keep the ball rolling. By the way, all off market. I won't buy anything that's listed. I'm not gonna listen. You make all your money on the buy in this game. So getting in a bidding war and paying brokers and stuff, you're shooting yourself in the foot. But not to say that there aren't listed deals out there that are worth it. And yeah, so that's what we do. We have 600 units. So we have a pretty robust portfolio. The Saxon Fund is a closed fund. Like I said, it's comprised mainly of family money and family office investors. And we're always actively pursuing new acquisitions.
Fantastic. Well, thank you, Marshall. And we're going to be digging into a number of those topics that both you and Aurelio mentioned in terms of tax and off market and how you play the games very similarly, but just slightly differently. So that'll be fun. Thank you and welcome again.
Sure.
And AJ, please introduce yourself and a little bit about how you invest in real estate. Oh.
I pulled an Aurelio. I was muted. All right. Thanks for having me. It's awesome to be on this panel. I love it when I'm the small fish on the panel. That's the right room to be in. So really excited to chat with everybody here. Lots of familiar faces as well. My journey through real estate's been it's been an interesting one. I got into the game 20 years ago, almost to the day, and basically started as a realtor and as an investor, started buying single family homes, duplexes, etc. And then went through the downturn. I thought I was a hero in 2007. And in 2008, I went through the downturn. What saved me though was that I had been buying good cash flow properties. And so I learned the lesson that as long as you're cash flow positive, you know, you're not forced to sell during a downturn. I learned that lesson. And thankfully I was able to, you know, continue to buy during that dip. And we had a long, pretty pronounced recession here in Kelowna from 2009 all the way till about 2013. It was good for creative deals. It was good for you know, learning how to, you know, do deals that were not exactly the typical inside the box deal. And I was fortunate, you know, I was a student of the game, reading lots of books and, you know, taking courses. And so I learned lease options, I learned agreement for sales and vendor financing. And I kind of became known as sort of the scrappy guy that could put a creative deal together. And in so doing that, I started to attract a lot of investors and became kind of an investor focused realtor and did that. I created my own real estate company called Vantage West in 2008. And we were very focused on real estate investors at the time. Did a lot of foreclosure work, a lot of distressed property stuff. I built my portfolio up to be fairly substantial personally. And I was helping a lot of investors just on a one-to-one basis acquire properties and sometimes doing things like rent to own deals, or where they would buy it and do a property first rent to own deal, and you can get great returns from that. And so going through that, I kind of amassed a fair amount of experience and created a decent network of investors. And a couple of years ago, I decided to create a limited partnership and looking forward towards what I think is going to be an interesting period of tumultuousness that we're going to go through after the end of this boom. And this fund is really set up for a down market where we can buy distressed properties. It's essentially an institutional buyer that buys property at a deep discount. Then we go in there, we fix them up, and then we use rent to own as an exit strategy. I like rent to own because you get a partner in that property that has some skin in the game. They take all the repair and maintenance off of our side of the ledger. They have down payments that we can use to further reduce our risk and cost basis on the property. And we have a pre-agreed exit price. And so if I'm going to go through a downturn, I like to go through a downturn with somebody who thinks they're an owner of the property, pays a higher than rent payment because they're paying a finance fee as well on top of that. And so that's the group of tenants I want to go through a downturn with. So we've got a decent portfolio now. It's about a $10 million fund, and we're looking to scale it, and we're having fun with it. And my job now is just to, you know, like Aurelio said, just to navigate, chart the course, and and find the deals. I was lucky growing up. My dad was a bit of a deal hound. He was never a real estate guy, but was just always looking for opportunity. And I watched him just not stumble, but find just the most amazing deals in real estate over the years. And he passed that on to me. So I'm pretty good. I'm a deal magnet. So I enjoy the distress stuff. And I like you guys said, both of you said, the deal's got to come to you, and that's the way it's done. So I'm fortunate now. I've got a real estate company that, sells 600 or 700 homes a year, and we've got almost 1,000 properties under management. So there's a lot of deal flow that just comes from that. There's certain situations, and then of course we're marketing that instant offer program all throughout Western Canada. So the deal flow is pretty high, and yeah, it's pretty exciting for a little group of partners that are doing this now, and I'm having fun with it.
Awesome. Well, thank you, Adrian. And seriously, do you want me to call you Adrian now, or is it AJ?
No, I don't even know why it says Adrian.
Okay, all right, good. I'm like, did you change it? So, my brother's name is Adrian. Sorry. So, AJ, there you are. What I'd like to acknowledge is that there's a couple of different ways that we can take this, and what I'd love for us to welcome AJ, and I'd like for us to talk about sort of your journey and some of the how-tos, and get kind of a little bit. We're going to go a little bit granular, but before we do that, because there's some things that align and some things that are a little different. But before I do that, I just want to make sure that we're super clear and all in the same context in terms of each of your strategies as I know them. So how about we do this? We're going to play it a little differently. I am going to summarize, Aurelio, and this is putting myself on the spot. I wasn't planning to do this, but I'm going to put myself on the spot and see if I can summarize very, very quickly your overarching strategies, and then you can fill in some gaps. How's that? So from what I heard from Aurelio and Marshall and AJ. All right, so I'll start with you, Aurelio, and feel free to fix me up. I'm going in the ring. All right, so what I understand from, of course you do lots of real estate all over. You're primarily in Canada and the US for very smart reasons. Of which I agree, but I understand that you have two main components: a tax-assisted strategy, as well as the funds that you have been creating, the real estate investment trust, the REIT, I should say. Is that correct?
That is correct.
Oh, awesome. Okay, we should have a little scorekeeper here.
So
all right.
that's kind of like, so the majority of, so just for clarity's sake, the majority of assets are still owned by me. I started the real estate investment trust, and I started with a grocery anchored mall, so to speak, because you got to start with something. Otherwise you make distributions and you don't have a something, and they call that a Ponzi scheme, and nobody likes that. So I started with that property, and then I bought the New York property, and now the government building here in Canada, and we're growing from there. But the majority of assets are still kind of like mine, so to speak.
Understood. But you're building this real estate, the
Exactly.
REIT, and starting to maneuver and position things under that REIT. And I know a lot of next level investors who are curious to know how that's done. Actually, each of you, that's why you're here, is to learn how that's done. But I wanted, for context, is to understand maybe, and you can explain a little bit about the tax assisted component, because there's different, how I understood it is that there's really two ways that you've created for people who have, so the tax assisted, if I may call it that, is those who have higher income, not a lot of capital. So think about ladies and gentlemen, think about the doctors and the lawyers and the folks out there who have higher income, not a lot of time. They may or may not have done like fantastic financial planning, but they know that they need to secure their retirement, and they need to do it and they understand the value of real estate. And so that, if I understand, Aurelia, do you want to just briefly explain
Sure.
that because it's such a unique concept. And again, like I'm saying, these guys have some really cool strategies.
Sure. So I don't know how many of you remember, but the early 90s were a bloodbath in Canadian real estate. That was the worst time I remember in my lifetime. It was a time where nobody actually knew when we'd get out of it. There was so much uncertainty and so many properties available. At that time, I bought quite a few properties in Toronto because there was a lot of power sales, but I bought the 75 townhouses in Alberta. And then I started thinking about who survived the recession the best. And it was basically the banks and people in essential services. So what I tried to do is I tried to marry the two. And I said to myself, okay, well, part of my general business model can be me being as a bank. And B, there's a lot of people out there who are cash rich but income poor. And income rich but cash poor. And the reason for that is it's just a sign of, maybe it's a sign of living in a first world country. I'm not sure. But when we came to Canada, you put 50% down on a house. The guy you bought it from took back a VTB mortgage. And then when he bought his house, he got a VTB mortgage from the guy who sold it to him. And you paid it off as fast as you could. And then you bought a car after. So we came to Canada in '67. My dad didn't actually buy a car, even though he was a construction worker. He didn't buy a car till '72 because the house had to be paid off. So we ended up coming to Canada with nothing, and by '72 having a house that was fully paid for, right? $21,700. At the time that we bought the house, it was 1,200 square feet. And because back in Italy, we were like really poor, there was like 4 families living in a house. When we bought the house, he said the house is too big for us. So we had to rent out half of it to another family, which was cool. But the money that he got from them in rent basically paid for the mortgage, and then all the money they made was used to pay it down. The guy that he bought it from, the guy who was renting, he ended up renting possibly forever, because we kept in touch for 20 years and he was still renting. And the only difference between my dad, who, you know, now has a house that's worth whatever, $1.2 million, and the guy who's still renting, is that my dad actually jumped in and bought a house. That's the only difference. The guy's paying a lot more money now in rent than my dad pays in property tax. So I thought to myself, because when I needed to buy a car, the question wasn't how much can you afford every month, it was how much money do you have. So if you have $2,000, you buy a $2,000 car. Now you have a kid who just graduated, lives in his mother's basement, driving a $60,000 BMW. And then they wonder why they can't save up a down payment for a house. So we have a new generation of individual, a new species, so to speak. And that is the high income earner who pays their tax. And then after they're done paying their tax and they pay their mortgage and their kids go to private schools and whatever, they have very little money left to plan a retirement with. And so a lot of people in the medical profession end up being those people. So we run a scenario where a typical guy, say, makes $250,000. He's married with 2 kids. He pays $97,000 in tax. Here in Canada, he's left with $152,000. And with that $152,000, he has to pay his mortgage, his lease payments, his kids, his wife, his
kids' Beamers, you know.
So what I thought was, why don't we develop a vehicle to help those people? And so I came up with a concept that's a tax-assisted real estate model. And it's based on the premise that most people are comfortable with real estate because they know somebody who has it. They might have bought something, their parents bought something cheap. So they'll come to me and they'll say, can you find me a house like this? And then I'll go out, and I'm using this only as an example because it's easier to understand. I'll go out and I'll find somebody who has, say, 50 of them, and I'll buy all 50, and I'll be able to get a better deal because I'm buying all 50 of them. And let's say that the price is, this might seem high to some of you who don't live in Toronto and cheap to people who do live in Toronto, but let's say it's $800,000. So I buy the house for $800,000 and I come to you as an investor and I say, here it is. And you say, well, you know what, I'm busy. I can't afford to look after this. I don't want to find tenants. I don't want to chase tenants. You do it. So fine, we sell you a 7-year property management, and you don't have to worry about any of that. Furthermore, we'll do a market assessment and we'll say, okay, well, that house will rent for $3,500 a month. So we're going to assure that you get $3,500 a month for the 7 years. Then you say, well, what if I hear that some tenants trash the place before they leave? I don't want to be on the hook for that. No problem. We're going to sell you a cash flow guarantee. So we're going to lend, not you, but the property, the money to fix it up. And then we'll get our money only from the property cash flow. In the future, there will never be a cash call.
Aurelio,
Yes.
I don't mean to interrupt, but what I want to do is I want to share this passion, and I want to summarize what I got out of this.
Okay.
Can I? So if because this is freaking gold, people. So what I got is that you've created essentially, and this is I'm gonna go broad strokes here, but you've essentially created a bank that's got the assets, that you're creating like a lending machine that's supporting other individuals to get in, and you've just created these redundancies with contingency funds, so that you're basically, no matter which way this goes, your clients, these folks who are high income earners but don't have the capital to get in, are positioned very well for their futures. They can take, down the road, they can get a little bit of cash flow now, if I recall, or they can take it later on in terms of retirement. But you're essentially playing the bank. Is that
right?
Fair?
Well, we do a little bit more in that when it comes to buying this place, the investor, let's say they wouldn't qualify. It's getting harder and harder to qualify for mortgage on rental property, as we all know. But I guarantee the mortgage. So me personally, I get the best rate, I guarantee the mortgage. And then to insulate the investor, I set it up as a limited partnership. And then furthermore, we hire an auditor so that the investor gets audited financial statements. So this property that we bought for 800, let's say it's worth whatever, $9 or $1 million in the open market, I sell it to the investor for $1.1 million. Those $300,000 in fees, they get to write that off over 6 years. So they write off $50,000 a year. I lend them the down payment. So let's say the down payment is $500,000. They're going to write off another $40,000 a year in interest income. So they write off $90,000 a year. It creates $45,000 a year in tax savings, which they can now use. They never had that money before. They can now use that to make their monthly payments on the loan, so that in 20 years, they're debt free. They'll have no note and they'll have no mortgage, because the mortgage is amortized over 20 years. So that, in a sense, is it. And what it does is it gives individuals an opportunity that normally they would never have. And more importantly, it gives people the opportunity to get their foot in. The same way my dad bought that house for $21,000. If they saw him coming down the road and said, look at that poor ignorant guy, I bet he doesn't have more than a grade 3 education, and they would have been right. Let's rip him off and he'll pay $25,000 for it. Guess what? He still would have it paid off now, and it's still worth $1.2 million. So long-term, price becomes inconsequential if you're starting and you give real estate enough time. It's like I tell my investors, I say, I can't guarantee you what it's going to be worth, but I guarantee you it's going to be paid off.
I love it. And you're getting ahead, because it's definitely a conversation I want to talk about, is that market and how we time the market. I know, Marshall, you've got some awesome opinions on that. So we'll just jump. Thank you, Aurelio. That's helpful and gives some context of some of the products and the ways that you've invested and supported other investors investing in real estate and accessing it. Marshall, let's jump to you and share a little bit, again, some context. You mentioned that you've got a family fund and that it's closed. So for those of you who don't know, but I suspect most of you do, that when you have funds and you're raising capital, whether limited partnerships or various offerings, that they have typically a time frame that they have to be constrained within. And so what I understand is that you're fully funded in your family fund, but you're considering having some new offerings coming soon. And I also know, of course, that you love to help others get the deal through sales and negotiating.
Yeah. Well, let me just say, I just want to circle back on what Aurelia was saying. First of all, I think, everyone who is participating in this, that was gold. That's good stuff. You see how in this game, he found a market, high income earners that spend their money. They don't have cash, and he became bank to those people. I mean, really, really smart stuff. I want to say kudos to you. It's awesome. That was very cool. So very good, Aurelio. Very cool. So the fund, so my fund is closed, but I am going to be moving into a cap raise posture on a few other things. So Saxon Capital is not just real estate. See, listen, guys, there's three things you have to have, okay? You have to have an asset that appreciates in value and pays you. I mean, this is my ethos every day. This is what I'm talking about and thinking about. One of those things is you can own a dividend paying stock, right? I don't own them, but you could. It could appreciate in value and pay you. The next thing is cash flowing real estate appreciates in value and pays you. And the other thing is a corporation. A corporation will appreciate in value and pay you and have other benefits. So not just real estate is what I acquire through Saxon Capital. I also do roll-ups of companies. And I focus on construction companies, being that's my thing, right? So I am opening another fund for specifically for roll-up purposes to roll up regional contractors. Don't necessarily need to raise money anymore vis-a-vis a fund for real estate deals, but we will do it at a piecemeal basis, but the fund itself is closed. So just to give some clarity on that. So I'm sorry, what else did you ask?
Yeah, no, I just wanted to give get into that context of which strategies and approaches that each of you are coming from, so that we can take our next layers of conversation into markets and market timing and how you raise capital and do you raise capital and all those things to the next level. So I think that's very helpful, Marshall, in terms of you created the fund, you raised money from family and friends, and
no friends.
No friends.
No, from family offices. I raised money through this thing, pounding this thing every day. The phones, man, old school. Listen, I got an opportunity. I'd love to get in front of you. Give me 10 minutes of your time. I'll show you what it's all about. Okay, so I want everybody on this call to understand that I'm not a trust fund rich kid. Okay, only later in life. Listen, I grew up like Aurelio, a mac and cheese. Our house was mortgaged for dad to pull the money out of it to keep the business going. I was not raised a rich kid, a poor kid. Only later in life did the business start to take off based on my dad's sacrifices. I'm not friends, dude. We didn't have any rich friends. It's all other people. Remember, people have everything you want. Strangers have everything you want. You just got to talk to them, man.
Yeah. Thank you, Marshall, for mentioning that, because I think it's really cool, your work ethic and how, the tenacity of everybody, bird dogging it and take the tenacity for being a real estate investor and for being a next level investor. It really just has to exist. It's a fundamental, if you ask me. Everyone here has overseen and overcome some obstacles and persisted when things might have been a little bit hard or a lot hard or upside down hard. And what I loved about your story, and I want to talk to it when we're talking a little bit later, when we're talking about how you raised capital and how you find, more importantly, how you actually find properties. Yeah, because you've got some really interesting strategies there, and I think that's very important. So just to recap though, pounding and I appreciate that. Getting in front of people, having presentations.
Listen, people can't listen, nobody can invest in something they don't know exists, right?
Yeah.
People can't do business with me if they don't know me, and people can't pay bills they never received. So the fact is, you got to get in front of people. Real estate's a contact sport. People need to know who you are. So, I built that fund the old-fashioned way. Now, listen, I should make it bigger. There's no doubt about it, but I have other obligations, and, I could take it to the next level, and I really should. But I'm kind of focused on doing some other stuff. Listen, what happens, guys, with real estate, when you own 600 units, that's cash flowing no matter what, you get lazy, man. you get a check coming in and everybody's happy. I'm just telling you the truth, right? Aurelio can tell you he's bagging it big time. So, but our just to circle, listen, this is who I am, man. This is what you're going to get, the straight dope. But just to circle back on the strategy, because I think that's kind of what you were looking for. My strategy is nowhere near as complex as Aurelio or Creative. We have a company that has money. I need to offset a tax burden. I'm looking to park that money and get cash flow, period. Number one thing, secure the money. So that's the game that we play. And, you know, we're able to go in and move in investments and buy a couple hundred units at a time. And that's the game. Now, the reason why I love the game is because the game that I play is heavy deal. It's heavy in the negotiating. And that's what I live for. As a contractor, you know, most people, they misunderstand what a contractor is. And the root word of contractor is contract. And so when you play at a high level, we're not a guy who swings a hammer in a van. You know, we have millions of dollars on the street at risk every day. My job is to cap the risk as best as I can. You do that through negotiating contracts with owners. So I really love the negotiation process. As you can see, probably my personality is kind of fit towards it. And I negotiate, you know, everybody knows where their strengths are, right? I really love selling and negotiating, and I'm a hard closer type. And for the deals that I look for, the deals that we bird dog and secure, that style and approach is very good, because I'm trying to convince somebody who has a golden egg to release it to me, rather than buying some stuff that anybody will sell, man. You want to buy a 12 cap, any idiot will sell you that property. Try buying something that is golden, dog. Why would that guy get rid of that asset? Right. So, you know, you have to get very creative with the deal, maybe keep the guy in the deal, but, you know, even get on your knees and beg for the thing if you have to. But I really love the deal. And that's why I'm in real estate and in the way that we play it. And that's suitable for us. You know, our returns, you know, just so you know, our cash on cash is probably 9%. And that's high for our stuff. I don't get anywhere near the returns of Aurelio, but it's a different type of asset.
I love this. We're just getting started. Oh my gosh. But Marshall, I mean, like your New York style, and I mean, just how you come in there and did you use the word dope?
Yeah.
I mean, wait, that's awesome. And I love this because
listen, everybody needs to know who they are, and they have to be who they are.
Yeah.
Right. And this is who I am, and this is how I do business, man. Straight up.
And it's awesome because, you know, and that's what I love about the three of you here together, is because you are each in your own skin 100%, and you're each your own individuals and your own personalities, and you've got all these different creative ways of being in the market. And that's like, there's hundreds of people on this call, and each of you is different, and each of you has your own personality, and finding out what works for you and works for your investments. And it's awesome. So thank you. For that.
Sure.
Appreciate it.
Cool.
All right, AJ, how the heck are you investing? What's your strategy? I mean, you mentioned a little bit about the rent to own, so tell us a little bit more about that specific cash offer.
Yeah, so I'm also a contractor, so I've got a building company and a development company as well. And then with the market climate that we've had for the last 3 or 4 years, it's lent itself really well to creating products. So I've been doing land assemblies and putting deals together where we can, just little small stuff, 14 here, 45 units here, little things that we can pick off. And so we've been doing that and bringing them to market successfully. So that's been good. And I've got the infrastructure to do all of that. If it's a purpose-built rental, I've got the property management team to do the lease up. If it's a product that we're going to sell, I've got the sales team to handle the sales side. And of course, the contractors, I can control our costs, and we've got some pretty good buying power and good contacts here in the region where we are. So for the last little while, Cash Offer LP has really just been leveraging all of my infrastructure. And so the deal flow, the distress sale stuff that comes my way, that's great. And then, you know, where my focus has been more often than not is trying to put these land assembly deals together and pick off, you know, key parcels throughout the town that we live in, which is Kelowna, BC. And so, yeah, what Cash Offer LP is really just an opportunity for my limited partners to joint venture with me on the juiciest deals that I see. So I've got a lot of tentacles out there between the property management, between the real estate company, and just being in the development game. There's just a lot of opportunity that flows my way, and the best way I can summarize what we do is we try to double our money in 2 years, and the way that we do that is by buying at a discount, improving the property, and selling at a premium. And the rent to own is the best way to sell at a premium. They will pre-agree to that exit price, and I'll structure the deal. I've got the loan guaranteed, so all of my limited partners don't have to do any borrowing. I've got the big master line of credit, and so we have 4-to-1 leverage on everything that we're doing, which gives us a nice levered return. And I'm aiming to be in that sort of 14 to 18% for my limited partners. All the deals that we do are meant to have 25 to 30% returns. And then after all the dust settles, that and GP LP splits, that should give my partners a nice mid-teen return. And that's been proven out over the last couple of years. It's been solid, and it's scrappy. I'm not in the situation now where we've got 500-600 units and it's kickback time and collect checks. I'm having to put deals together to meet these types of to keep that rolling, and it's a lot of me in the trenches still, and I'm excited to do that for the next 5 years anyway, and go for another big run and scale the heck out of this thing.
Awesome. I love it. And I love that we're in different stages as well. AJ, I know you put together your limited partnership, and I'm personally just creating a limited partnership in the US. So I'm it's just that next level and trying to bring it all together. And so it's great to have Marshall and Aurelio who've done some of the scrappy, and we're all at different stages.
That's cool to listen.
Yeah, it's great. That's awesome. Well, thank you, AJ. So I'd like to switch gears a little bit and go down this path because I've heard each one of you mention distressed properties, but I'd like everybody in here to actually put in the chat, if you don't mind, this is interactive, please put in the chat, what do you feel like, how would you define a distressed property? What is a distressed property? Type it in the chat, please. And I can see some of you, and I know who you are. So that's right. Opportunity. Nice, Lewis. All right. Arson. Okay, that's helpful. Thanks, Kyle. Okay, so it had experienced some damage. Okay, what other distressed properties are out there? Tired investors. Bought a plaza from a 99-year-old. Okay, divorce deal. Disgruntled landlords. Thank you. All the big D's. AJ, go ahead. We'll get to you. Daughter could not manage. Right, as Aurelio was saying in terms of longevity, individuals not wanting to have a succession plan, something with a problem due to a property tenant. Yep. Thank you, Naran. Elaine, crime. What, like vandalism, Elaine? I'm assuming maybe? Or was it the area that was filled with crime? Okay, rundown, under market rent, seller in distressed state. Thank you, Havan. Foreclosure. Rob, yes. So thank you for participating. Appreciate that. Because what I saw in here was when we talk about distressed properties, like you'll hear that out in the market all the time. But what I really want to make sure is that we're not just thinking about distressed properties. Yes, they could have vandalism, or they could be in distress or deferred maintenance, one of the big D's. They could have had, all of those things. But it's actually, the property might be a friggin' diamond, like Marshall was talking about, and you might have distressed people, distressed circumstances. So I just want us to really recalibrate when we're thinking distressed. It's not just distressed properties, it's distressed circumstances. So with that said, tell me about how you get deals. So Aurelio, you just mentioned that you got a distressed property because of the circumstances. Tell us a little bit about how you do that.
Well, I'll give you an example. In 2010, they had a bit of a meltdown in the US. Their banking was having issues. Everyone took money, including Bank of America. So I got in touch with a few realtors, and I bought 7 properties between 2010 and 2012. 2 in Wisconsin, 2 in Chicago, 3 in Florida. So what happens in a bad market is that It's not the properties that are distressed, it's the owners. So if you're an owner and you have 10 properties and 4 of them are losing money and they're going to take the ship down, and 4 of them are breaking even, and nobody wants to buy those. Nobody wants to buy those. But you have 2 properties that are exceptional. Those are like what Marsha referred to as the diamonds. Those are the only properties that are going to sell in a bad market. And so I ended up buying really good assets, but I got them from people who we have a term. I didn't invent this. I got it from a guy I met, like, when I was in my mid-20s, and it's weak hands. So properties in weak hands. And so that's what I did. That's what I did there. And then in Canada, of course, we had our own kind of ups and downs up until probably like 2010 or so. We were still seeing powers of sale come up in particular areas. So receivership sales as well. And those are still happening because companies can take on a lot of debt. And then it's the company that's the weak hands. It's not the properties. The properties are excellent. It's the people that own the properties that aren't in such excellent shape. And so we're actually expecting a sizable package to come out now from a receiver that has 11 medical office buildings that they're going to have to sell. Now, the office buildings are great. They're first-class assets, but the people who own them are no more. So that's what I mean by distress. I don't think anybody, well, I shouldn't say anybody. When I was young, I used to be a slumlord because that's all I could afford to be was, you buy rooming houses and you buy triplexes and not so great areas because the cash flow is great, but there's a toll to be paid, an emotional toll to be paid.
I see a few heads nodding, Aurelio, of some of us who started in there too. So yeah, we gotcha. Go on.
I don't want to be part of that anymore, obviously. But there are plenty of opportunities out there from time to time in various markets, and that's why I'm not geography specific. I'm not use specific. So I've got multi-unit residential, I've got industrial, I've got medical office buildings, and I've got commercial.
Aurelio, I'm going to jump in because I actually want to dig into this. This is what you're talking about is a whole nother golden nugget. So can we put a little pause on that one so that we can come back to it and go for it a little bit? Yeah. Okay. Thank you very much. Because you guys, you've got to hear this about diversification because this is also going to blow your mind. So in terms of these distressed properties, again, not just distressed, you just handled it, you just classified it beautifully, Aurelio. You too have medical offices and plazas and all of these things and other offices that it wasn't the building, it was the people or even the company behind it. So as we reframe what we're looking for, I'd really like, Marshall, I'd like you to just talk a little bit about how you get your deals because you do it in a very a different, not even a different way, but just go for it. Tell us how you do it.
Okay, well, listen.
First of all, tell us what kind of property you typically go for. As you mentioned, the diamonds.
Yeah,
Okay?
I'm looking for diamond
Right.
AAAs. I'm looking for properties that are near Whole Foods and Starbucks, man. I want nurses and I want those guys. Those are my tenants, right? And union construction workers, but teachers. I'm trying to shake free good deals. So it's funny if we're going to use weak hands as a definition for distress, dependent upon the owner, then yeah, I guess so. I would never think of it as me going after distressed properties, but I guess by the way we're talking about it today, yeah, it makes sense, and I think that's great actually. I have a team of people that call owners all day, every day. And they know us very well. And at any given time, I'm trying to hit the timing correctly. You never know why someone will dispose of an asset and sell it. You never know. Okay, there's a million reasons why. Okay. All I know is that when the timing is right, I want to be front of mind for them and I want to be the guy. So I have a team of people bird dogging deals throughout the country all day, every day. So I look at a lot of deals I do not like. A lot of deals don't fit my criteria. But I do it the old fashioned way. On CoStar, we identify properties and we give them a call. Imagine that. You give them a freaking call.
Not even a text, huh? What?
Not a text. You call the guy and you make a relationship with the guy and you let him know who you are and that you got a bag of cash for him anytime he comes to reality, to his senses. That's what we do. That's it.
So another way of framing that, Marshall, is you're picking your properties that you want. Like you say, you're finding the ones that are strategically situated for your portfolio in advance, and then creating relationships for them for when they're the owners, the current owners, for when their circumstances change, that either something in their life changes materially and they become not necessarily distressed, but in a circumstance that life has changed and you're right in front of it.
Sure. Many different reasons, right? I mean, they have to sell, they want to give money back to investors. There's no succession plan. There's a million reasons why, right? And you have to imagine that the criteria I'm looking for is a finite amount in the States, especially the Sun Belt is what I focus on. I'm following the Great Migration, right? Because, in this country, we're a renter nation. And that's where success has been for us. So, it's the same people over and over again. So they know who we are. Hey man, checking in on you again. You ready to do this thing? Can you give me some time? And it's a no. And it's just what I call a constant gardening effort of us to continue to follow up, fortunes in the follow up. Aside from that, other deals do come across my desk though, because, once you're in the game, you start building a little bit of momentum. People know what you're looking for. You create a feeder network and deals come across your desk. But we actively go after deals that are off market. We do it by calling owners.
Yeah, beautiful. And that's exactly as Aurelio and AJ also said, in terms of like, you're out there actively, but also your brokers. I mean, they don't chasing the deal, but at the same time, because sometimes at a certain level, they just find you. Which is awesome as well. So it's a little bit of both.
Listen, no, I'm going to push back on that a little bit. I guess they do. I mean, I deal with a Marcus and Millichap guy, but I try to avoid him like the plague. I'm just real. I'm just being real.
That's cool.
I'm not, I don't want to deal. Listen, they work at a different pace than I do. Guys that are in that business have a different demeanor than I do. Real estate guys are slow, man. They represent the asset, slow and steady as she goes, right? My personality is a little bit faster and harder. I got to put a building in the air faster. I'm going to get sued every single day that I'm late on the schedule. So that is who I am as a person, right? And I just don't want to deal with people who are going to be a hurdle in my way and people who are slow. So listen, just because I say it don't make it right, and I don't do it the best, but my program's worked out pretty good.
Yeah, right on. Absolutely. I think having it forward thinking and then also being open to what comes across your desk if it's the right fit.
Let's roll.
That's it. Cool. Now, AJ, you've got an opinion about distressed circumstances for real estate. Why don't you share you mentioned the big D's. So what are those?
Well, yeah, it's drug addiction, divorce, and deferred maintenance. It's all the stuff that you don't want to see people going through, but they do. And there's times in people's lives, maybe it's weekends, like Aurelio said, but they need to dispose of the asset. What I did, my strategy to find distressed properties has been to go a little upstream. I copied what you see in the US now. You see Open Door, OfferPad, Zillow offers. They're offering an instant cash offer. They're allowing homeowners to hit the easy button. Well, they're overpaying for properties all over the US because there's so much competition. But in Canada, we don't have that competition. And it's a novel concept, this idea that you can skip the hassle of selling your home. You can skip the open house and you don't even have to clean up. And you get to be in full control of the closing date. You get to be in full control of, like I said, of the timeline and how it happens. There's obviously going to be a bit of a premium you're going to leave on the table for that convenience and for that certainty, but there are a lot of people who are willing to leave 15% on the table for the absolute certainty. These are people who've maybe already bought. They're people who want to take advantage of an opportunity that is time sensitive. There are people who have inherited a property. There's people who have been, like you say, they're going through a divorce and it just needs to end, baby. There's lots of reasons why someone will hit that easy button and sell to someone who can close in 7 days, all cash, and can give them time to move out. It's the ultimate convenience. And so what we did was we created a brand, which was called cashoffer.ca or Cash Offer Canada, made a nice website, and essentially just copied the marketing of Open Door and OfferPad down in the US, which is sell fast, stress-free, skip the hassle of selling your home, all those types of hooks. And we just put those out there on Marketplace. We put them out there on Google Ad Network. We have billboards, we have radio, and we just hammer it. Like you see wholesalers all over the US, but it's not a big thing here in Canada. And you've got to kiss a lot of frogs to get to the prince. I say no to 99 out of 100 deals, but that 1 out of 100 is a gem. We just bought this property, in downtown Kelowna. It's worth $1.5 million. We got it for $10.50, right? I mean, that's a huge discount because these guys needed out of it. There was a drug addiction in the house. There was a bunch of lowlives hanging around. They had money. They just didn't want to deal with it. And so, they couldn't list it. The place was it was a piece of crap at the moment, but it didn't take much. We went in there with 50 grand, cleaned the place up and, resold the thing and made $500,000 in a very short amount of time. And that's in a hot market. I mean, you don't see a ton of people wanting to leave money on the table in a hot market. When this thing turns, we're going to have our pick of the deals because we're offering people to get, a get out of trouble free card here with this instant offer. And so our margin of safety will get deeper and deeper. But the message to everybody here is just to get upstream, like whether that's saying, hey, I'm cash, talk to a bunch of realtors and say, I'm all cash. If you've got a listing that's aging on you and you want to throw a Hail Mary with a quick offer, I'm always there. Make sure these guys know that you're there, right? You don't necessarily have to start your own brand. You just need, a dozen people or so knowing that you're cashed up and ready to go and you can close quickly. And the deals will manifest.
AJ, I think that's really cool what you just described too, of being upstream, and Marshall with relationships, and same Aurelio with relationships from all sides. And interesting, I'll just share a recent story of me in the Kelowna market, waterfront property, hot market, vendor take back 85%, came with a dock. I mean, like you name it, gorgeous thing. And short-term rentals allowed, the whole thing. But it came to me because of the relationships that I've created and manifested over the years. It came to me, but it's not like, this is where next level investing comes into play. And it was not a distressed property in any way, shape, or form, but these folks needed to just get out of it for tax purposes. They were like, we gotta our taxes are a mess, and that's what they needed to do. So even in hot markets, even on beautiful properties, when you don't expect it, just be ready to do the deal. So thank you, all of you, for that. So I'd like to jump into, I'm conscious of time. I could talk to you for forever. There's so much going on here. But I would like to definitely talk and come back to you, Aurelio, well, all of you, about diversification. Because at the Real Estate Wealth Lab, we look at diversification just a little bit differently. And so I'm going to leave it there because many of you align with our concept of diversification. So, because it is important to know your markets, there's no question, and to know your neighborhoods and all of that and do your diligence. But it doesn't have to be all in one place. So, and on all these things. So Aurelio, just would you mind talking a little bit about how you diversify your portfolio?
Well, we look at the local market, and you might not like living in Sudbury, but there's 300,000 people in the Sudbury area. So when I first got into real estate, I met a lot of old school investors that thought anything north of Highway 7 was rural Ontario. I kind of took the opposite approach. And so I started buying properties wherever the opportunity was. So I'm in Pembroke, I'm in London, I'm in Hamilton, I'm in Alliston, I'm in Espanola, I'm in Appleton, Wisconsin. So I'm not geography specific. Of course, I go there and I make sure there's, people there, people like living there, good neighborhoods, whatever. But I mean, everybody wants to be in Miami or San Francisco or Manhattan, but are we going to be able to get the yield there? And how are we going to fare during recession / pandemic? And I know a lot of property owners suffered. The big guys suffered during the pandemic. Our worst month was April 2020, and our collection rate was 93% of usual. So it's just what it is. I'm not, I didn't do anything except chase deals all over North America. But that's just it. Nowadays, we're looking at other opportunities. For example, in the multi-unit residential market, I mentioned that rents in Parry Sound have gone up 50% just in the last 3 years. So we spent 20 million bucks and we built 70 apartments in Parry Sound. We'll be finished by the end of January of next year. We're going to be building a purpose-built rental in Angus, which is just part of Barrie, Ontario, and one in Simcoe, Ontario. And the beauty is that we don't have to pay for the land because we have excess land on our plaza properties. So that changes the whole dynamics of the numbers, because normally you'd be at a 4.5% cap rate for a brand new rental. But because we actually own the property and the property's free, we're at about a 6.5 cap when we build brand new.
You're making me so excited. I got to interrupt Aurelio, because you also said right there, what I heard is that you're also building your own ecosystem because you own a plaza and now you're putting in residential that's going to support the plaza. Did I hear that right?
And we're building mini storage too. So we had a consultant give us an assessment of 9 different locations where we have properties, and we will be building mini storage as well, because if you've been following the whole, occupancy / return over the pandemic, mini storage has fared exceptionally well, and so has multi-unit residential, of course. So we're going to be building probably around 5 in the next couple of years. So we're going to be in the mini storage, we're going to be in the multi-unit res, we're going to maintain our general business model, which is a typical phone call would be a guy calling me, a realtor friend will call me, and it'll be a property in the middle of nowhere, in a town nobody's heard of, and he'll say, Aurelio, you're the only guy I know that will buy this. But the tenants, like, for example, when I bought the mall in Kapuskasing, the tenants were Canadian Tire, Shoppers Drug Mart, TD Bank, Circo Day, and then a bunch of smaller guys. But the anchors were there, and it was next to an independent grocer, which is Loblaws. So I didn't have to worry about the tenancy. All I had to do was fix some issues, because the problem is when the property is under receivership, receivers don't have outside money. They cannot drag in a tenant. So what they had to do to put in the Canadian Tire is they had to give them 20 years worth of free rent for free. So that Canadian Tire went and built out their own store. Well, guess what? In 2023, the 20 years come up. So all of a sudden, their rent goes from 0 to $257,000 a year. So it's that kind of stuff where maybe you just have more of like an open mind, and you do. I know it's not glamorous to get in your car, drive 7 hours to a little town, and spend a few days there, but you got to do it. Like, you got to go there, you got to walk the streets, and you got to feel comfortable with what you're doing. And a lot of guys work in an office and they don't like that kind of thing. So
Boots on the ground. But I want to summarize, because there's a lot in what you said, Aurelio, in terms of how you diversify. So You're diversifying in your locations, but you're also diversifying across countries in the US and Canada. You're diversifying across asset types, so multifamily residential, mini storage, office, retail, etc. You're also, it sounds like you're also diversifying again across asset class. I didn't necessarily hear that, but I think some were at different levels, like in terms of the smaller plazas and then some of the larger plazas. Then also across industry and also across, obviously, clients. So that's a lot of diversification, which is very cool. Did I capture that?
That was excellent.
Okay, right on. Very good. And Marshall, you also diversify. So tell me a little bit about how your diversification works. Oh, and you're on mute. Sorry.
Yeah. Okay, well, I don't want to make it wrong. In real estate, I don't diversify. Okay, just so everybody knows, like I'm not that guy. I put all my eggs in one basket and I wash that basket. I don't diversify, like I don't own storage. And I only own multi-unit and in a particular type, but
multifamily residential.
Yeah, multifamily.
Thank you.
But I do diversify my asset collection, my portfolio with rolling up construction companies.
And location.
Yeah, oh, you considering that diversification?
Yes, it's part of the whole conversation.
Okay. I wouldn't consider that diversification, same product.
Perfect.
So you got to look at the deal wherever the hell the deal is, right? So a deal is going to be a good deal wherever it is. If it's a bad deal, it's a bad deal. If it's a good deal in South Carolina, it's a good deal in Connecticut, I'm going to buy it. I don't care where it's at. Yeah, if you guys are location locked, then yeah, that's going to be an issue, right? Every deal needs to stand on its own merits. Okay, so you have to know what's going on in the market at all times. That's why, just to circle back to what I was saying about brokers and stuff, it's good to use them as a resource locally of what's going on, because I can't know necessarily everything that's going on in Alpharetta, Georgia. But I can download a broker's brain, right, by having a conversation with them and kind of leading them on a little bit. But yeah, okay, so if you want to consider that diversification, I apologize. Yeah, I am diversified.
I shouldn't say I necessarily, I do consider it, but I want to make sure that everybody's in the same conversation. Is what does diversification mean to you, Marshall? And so, okay, in your world, that's not
to
diversification.
Me, it's a different asset. Yeah, to me,
yeah.
I mean, yeah, to me, it would be a different asset. I just think that, instead of buying multifamily, now I'm buying storage units, and now I'm diversifying my real estate collection portfolio. But buying in different locations, most certainly.
Right. So you're laser focused.
Yeah.
You're laser focused on AAA as much as possible. And
yeah, listen, I'm 100%. I'm laser focused on inflation hedging assets, and real estate being the number one. By the way, I also own a ton of Bitcoin. So I mean, like, I am diversified in my asset holding I'm owning inflation hedging assets. I mean, that is like what I go mad about all night while I'm laying in bed. Where am I going to park money next? But yes.
Awesome.
Yeah.
Very cool. Thank you, Marshall.
But let me just get, edify you on that a little bit here, right? Because I know that I can be abrupt at times, but
we love it.
Yeah, well, listen, man, come on, man. What do you want me to do, right? So the asset itself, I'm looking for the same ones all the time, but every deal needs to stand on its own. Okay, so like, I don't care where it is. If I get the information and the intel that the migration is happening in this area, it makes sense. I could get the data from local sources, and that deal, a lot of times, guys, it's interesting. These deals have to pass the sniff test. It's like this internal test that you have. You could be so data driven and analytics driven at the same time. I feel like I could almost, I don't know if AJ can attest to this. I'm sure Aurelio can. I could walk and look at a deal and I know that this is the right deal. I get the feeling like I'm going to buy this. I need to buy this because, at the end of the day, nothing is going to be perfect. There is no perfect deal. That's why we all on this panel turn down almost everything we see. AJ said it perfectly. I touched on a little bit. I look at deals every day and I don't buy them because they don't make sense. They don't pass the sniff test. But when it does make sense, you got to pull the trigger on it, because, you know, and we discussed this earlier, and I don't know if you're going to go into timing, market timing, but I asked myself, would I rather own the asset or not own the asset?
Yeah.
And I don't want to be caught in a position where the asset starts running away from me. I'd rather always own the asset, right? So I don't care where the deal is. As long as the deal stands on its own merits, it makes sense, then I'm going to buy it, you know, within my criteria, which is typically the Sun Belt.
Right.
So, even though I got 300 units in Connecticut. Crazy, right? You got to remember the biggest thing. I mean, AJ's sitting there laughing, right? I mean, you got to remember the biggest thing in real estate, your number one exposure that you cannot cap, and your number one risk is your taxes. I can control the cost on everything else. I cannot control the government, right? So this is what I mean, this is the straight dope. This is the pro stuff. You know, I was thinking about what Aurelio was saying. He put 70 townhomes up for 20 million. Second, he said development, my ears perked up, right? Now you're entering my world. I'm going, okay, 20 million, that's $250,000 a townhouse. But that's not per townhouse. It's obviously including all the site work and everything. So that's actually pretty good. And that'll be a good deal for you. So congratulations to you. But like, he can cap his risk on his construction costs. He could tie the hands of his contractors. He can have damages for delay if they're late, right? He cannot control a crazy Canadian government. I can't control an insane Democrat Connecticut government. I'm not making this a Republican Democrat thing. I'm just saying it's mainly the Democrats that they're going right here in my pocket. So another reason why I go to the South, right? Those are red states. I get to keep my money, and I can kind of have a control over a risk that nobody here can temper. Another reason why, I'll just tell you again about diversification if I can. I'm in contract now for a deal. Actually, I broke one of my cardinal rules. I'm in contract for a deal right now in Newark, New Jersey, right? I don't know if you guys are familiar with Newark, New Jersey. I'm doing a deal in Newark, New Jersey because Newark is for sale. Okay, it's got an international airport. It's got a professional hockey team. It has a main station called the Newark Penn Station. And these are hub zone and tax abatement properties, right? So if you get a tax abatement, I'm on it like shark the blood. Because my main risk is the taxes. Because of the types of assets I buy, I don't have enough cash flow in these deals to like offset crazy tax increases when politicians want to spend my money, right? Politicians going to print money. They're going to erode every dollar in your bank account. That's why we own real estate as an asset, as an inflation hedge. Everybody here knows that basics. Mm-hmm. But as an asset owner, they're also crippling us by raising property taxes, especially here in the Northeast. So if I could find an tax abated property, I'm all over it. And the reason why I'm saying this, I wanted to make this point before we left, because I don't hear many guys talk about this on panels. The cost that you cannot control is always going to be your property taxes. So think about where you're buying. And if you're buying deals like me that are 5 caps, okay, like you gotta take into consideration, I mean, how much if taxes increase over time and we end up in a crazy scenario, which I think it seems like we're probably heading towards, is your investment going to be viable?
I love what you're saying, and that's actually one of the topics I wanted to get to tonight, but I know we're running short. No, I love it. Thank you for bringing it up, because it is so important. I mean, tax abatements and those property taxes, and also that affordability conversation. So what I'm going to do is I'm going to invite everybody here, obviously, as part of the free trial with the Real Estate Wealth Lab. You have to come out October 27th to our next research lab, because we will be talking, I'm getting right into what you're talking about, Marshall, is the government. What can the government control, and what do they think they can control that affects our ability to provide rental housing and other property services to individuals? Because it's a major topic. So
it's a major deal, especially with you guys up north there.
Yeah,
I follow you guys. I have some Canadian investors, and so I feel for you, man. But I mean, it's we're entering crazy times, man.
Yeah, we are, and now it's the time to be watching that even more closely. So yeah, definitely come out. AJ, I know that you've got a hard stop in 2 minutes. Is that correct? So maybe I'll just skip to, and please, everybody, put your questions in the chat. If we don't get them to today, we're gonna have them for future. There's lots of market leader labs and other ways that we can address your conversations. What I'm going to do then is a very, very simple closing while AJ is still here. Is I wanted to ask each of you, and AJ, you get to go first, is we want to talk about markets and ups or downs, because Marshall, you and I had a great conversation about it as well. So
Yeah.
up or down market, when do your strategies work best? AJ.
Oh, sorry.
Yeah, sorry,
sure.
I gotta switch it up. Sorry, my friend.
Yeah, so distressed property buying is a down market. That's where the bread is buttered. But right now, doing the construction and building that product, we're doing really well, like overshooting all of our targets on the stuff that we're building and selling. So you deploy the right strategy for the right market. But so we've made that pivot to building more product. But I would say that the limited partnership main strategy of buying at a deep discount and using a rent to own exit is going to work better in a down market.
Awesome. Very good. And where do you think the Kelowna market is going these days, AJ?
I think we're in the third trimester of a boom, and I think we're going to see a little softening here in the sort of second quarter of next year. Would be my best guess. I don't have a crystal ball, but I definitely think we're going to see a little bit of easing, and how bad it gets is going to be dependent on all the different black swans that may or may not be on the horizon. But in any case, we'll make sure we're buying diamond assets that they're gonna weather the storm.
Well, the Real Estate Wealth Lab agrees with the assessment, and the forecast is definitely a softening over the next 5, 6, 7 months into the spring, especially in these hot markets. We will see some of that softening, so there will be an opportunity to buy for sure, but we are seeing a long expansion. So I would like to say thank you so much, AJ, for being on. We're not closing this up just yet, but I just wanted to acknowledge, AJ, if you have to leave, we understand, because I want to finish out this question at least with Aurelio Marshall. So.
Yeah, I'm gonna hang out and just hear these guys' answers. I've learned a ton listening to them, so I'm gonna wait 5 more minutes and hear what these guys have to say.
Oh, all right, perfect, gotcha. All right, so Aurelio, I'd love to hear from you. Up or down market, when do your strategies and approaches work best?
I don't work on the basis of an up or down market. There's a recession going on somewhere in North America at any particular time. It was Alberta last year. It could be Florida next year. It could be California. People are moving out because it's expensive. So I don't look at it that way. To me, if it's a bad market, then I'm getting more calls. If it's a great market, somewhere there's a weakness, and it's not necessarily a like I mentioned before. It might have nothing to do with property at all. It might have to do with either individual circumstances, or who knows, if they put a tax on inheritance in Canada, I think we're going to see a lot of properties sell before that happens, right? Yeah. So it's more of like a wait and see. I've gone times where a year has gone by and I haven't bought anything, and then the next year I'll buy 3 or 4 because that's when the opportunities were. So I'm not a wait and see kind of guy in terms of I'll buy when this is happening or that is happening. Stuff's happening all the time. We just got to, in any given time in our history, there's entrepreneurs that have taken advantage and have become rich in the last 5 years, 50 years, 100 years, whatever. So the whole issue of timing, I think, is for people who think single-mindedly. But just to give you an example, and it's no secret that the retail footprint has been shrinking over time. The Amazons and the Walmarts have come to towns and whatever. So just to give you an example, where I'm building the 70 apartments in Parry Sound, well, that used to be a Metro supermarket that we knocked down. We built 70 apartments. In Kapuskasing, when I bought it, it was half empty. So I moved everyone to the front and actually knocked down 80,000 square feet of building. And there's a gravel parking lot there where a building used to be, but we lowered all of our costs, right? You don't have to heat it, you don't have to cool it, you don't have to clean it, none of that. So I think what I've learned, because I have kids, is that the days of passing on multi-generational wealth to, let's call it a bumpkin, a not so bright offspring, I think those days are gone. I think you have to teach your kids how to think on their feet, because the market is changing. Real estate's changed more in the last 10 years than I think it changed in the last 50 before that. So we always have to navigate these waters, and we have to teach people how to navigate the waters. Just learning how to, sail a boat isn't enough anymore. You have to know about the crosswinds and the waves and the moon and everything, right? So I don't think there's ever been a better time to make money than in the last little while, because we are seeing a lot of different opportunities that we know about now. The information is out there. We know what's growing. We know what is inflationary and what is not doing so well. So armed with that information, we can go out and make a place for ourselves. As far as the uncontrollables, like taxation, and this is a Canadian attitude that I have, and I'm the first to admit I'm exceptionally biased, but I wouldn't want to live anywhere else in the world, and the price we pay is tax. So we have to live with it. If we're gonna live here, we have to get used to it, and it might mean, like us, we have a lawyer that we use, and he reviews all of our property taxes continuously, and he fights with the towns. And the beauty of buying in smaller towns is that they don't have the ammunition of the bigger towns. So if you put $1,000 an hour lawyer in front of them, who's very well versed, they can actually be very persuasive to a town clerk somewhere in the middle of wherever Ontario. So we actually have done really well that way. And because of our bulk now, my insurance rates are less now than they were 7-8 years ago. And that's just through volume buying. So there is an answer out there for things. Maybe it's just the difference between being in the business full time and not, but opportunities do present themselves when you do have some bulk and some information.
Wow, I hope that people were taking notes, and I see a lot of people with their heads down and pens going, because Aurelio, there were a number of gold nuggets in there, including in terms of, well, the last two that just blew my mind in terms of insurance going down. What? This is like the insurance crisis of a decade or of a lifetime. And you're saying that because of your volume approach that you're having insurance rates go down. That is incredible. And that also is very hopeful for those of us building portfolios, that there's options and possibilities. Mandy, I see that you see that's awesome as well. And then also the concept of having a tax lawyer, like basically a corporate tax lawyer who goes and negotiates on your behalf with the cities at the municipal level. That is fascinating. So those are some top tips for sure to consider as one wants to have a different kind of next level conversation about real estate. And then just to cap that off, in terms of the market, again, it doesn't matter if it's going up or if it's going down. There's a recession somewhere, and you just keep on going when you need to, and know that it's for some of it's for the long haul, and then also taking some extreme measures when it's not. Level that. That's a great attitude. Cool. Thank you, Aurelio. Marshall, got to hear from you on this topic. So let's hear it from you on timing the market. Oh, yeah, there.
Okay. Okay. Well, I mean, I think we kind of touched on it. Aurelio is very eloquent. Nobody has a crystal ball. I don't think anybody really knows what's going on at any given time. Everyone has a hypothesis. Some guy's going to be right. Some guy's going to be wrong. I think it's easier for me to take that laissez-faire approach because of the type of product that I buy. It's going to perform in all markets. And I'd rather have the asset than not have the asset. And I'm going to look at the deal based on the merits of the deal, and no matter what market I'm currently living in, right? So we have to do deals in a bad market. We get the opportunity and benefit to do deals in a good market. I'm taking them one by one, and I'm not necessarily looking at it that way. And Aurelio, he eloquently explained that. So.
If I may though, I concur. That was very, very eloquent. Thank you, Aurelio, and articulate. Something that I think would be valuable for you to share, though, if you don't mind, given when we had our conversation with all of the folks on this call, that really stuck out for me is because we at the Real Estate Wealth Lab, that's something that we do. We've got the real estate cycle formula. We are monitoring the reverberation and identifying, the duration of a cycle, and actually even starting to look at the actual amount of how much will it fluctuate up or down.
Yeah.
But and I love it because that's really, it's great information to help us make smarter decisions and at least know what to expect or to re-strategize.
Yeah.
But something that you said is that you kind of agree, if I heard you correctly, you agreed with that. But then there's also this sort of like this conflict, because I share the same value as you and of everyone here that Aurelio just eloquently said. It's like, get in and hang on to it. And you're going to be fine. And it doesn't friggin' matter what the market's actually doing as long as you're paying attention to your asset.
Yeah. Yeah, no, absolutely. The what you guys do is great. And the analytics that is provided and all of that data accumulation, those are very useful. I'm not that smart of a guy, right? So, I'll take that information, but what I will use that information for is a lever and use it as a justifier to negotiate price in a deal. But I am not necessarily going to use those metrics as a green or a red light for me to pull the trigger on a deal. So, so that's how I feel, because I want the asset. If it passes the sniff test and it checks all the boxes, right? The analytics, I think, is a supplementary adder to my arsenal in negotiating the deal. And just to circle back on what we were talking about earlier on the taxation thing, because I just can't let that go, Aurelio. You want to pay taxes, pay them all, bro. It must be my American thing, but if you need a tax attorney to advocate for you on owning real estate, you're mad. I wouldn't do it. I wouldn't pay it ever. I'm going to go to it. Listen, politicians and their stupid spending and horrendous taxation to kill me as a real estate owner, which is my right by God. I am not going to play that game. I'm going to go somewhere where the waters are warm and the ground is fertile. I think it's crazy to think that because of their bad decisions, I got to pay. That's nuts, man. It's nuts. That's the difference between Americans and everybody else. Listen, I don't want to start a war. It's just who I am. You feel like it's okay to pay a premium because you live in the best country in the world, and then go for it, dog. You live in the best country then. Not me. I ain't paying, Jack.
Well, I love this. We've got an international relations.
Listen. This guy Aurelio's been in the game. I take my hat off to you. You're an elder statesman, and you definitely have forgotten more than I'll ever know. No question about it. But I just think to me that just itches the wrong bone, man. I can't do it. So. Look at this guy, Rob, laughing. Listen, I'm a New Yorker, dog. Listen, it's crazy. Why are we buying these assets in the first place? Because my dollar is eroding every single day in an account, right? Yeah. I own 137 Bitcoin, man. I did that because I saw that was the mover, and my money is getting killed in the States, man. Look at my guy. He can't even speak. You don't even know where he is half the time. But he's going to take it. He's going to take the long arm of the law and put it in my pockets and screw me royally. And the answer is I'm going to pay for a lawyer to advocate for me in front of some town clerk. Isn't that crooked? Isn't that by definition like a crooked society, that I got to get a lawyer to advocate in front of me to convince this guy? So what about the other guy who don't get the tax attorney? He gets a raw deal, you get the good deal. How's that fair? It's crazy, man.
It's really interesting, and I love that you're bringing up the inflation card, because actually for those of you who are partaking of the trial, the Real Estate Wealth Lab free trial right now, you would have been emailed your newsletter, the Real Estate Intelligence newsletter today, and in it, Marshall, just as you're talking about, here's a mind little screw here. Think about, okay, so we all know about inflation. Okay, sure. And we're going to have lots more conversations about that, and things are getting expensive and whatnot. But what about this? As real estate prices are not going up, the value of your dollar is going down. That's inflation. It's just a different way of looking at it, but it's the same outcome. So just some things for us to consider, like how this is all going to play out and how much inflation is going to come in, because there's a lot of indicators that are suggesting that we're about to go into some pretty significant inflationary times.
And we're already there. Ask Aurelio. He's building those townhouses. You know he has supply chain issues. I got supply chain issues on every job.
No.
It takes me 9 months to get windows. Okay. And I mean, listen, my partner in builders on this call, he'll tell you, man, if you really played his game, you know inflation is here big time. Supply chains are broken down massively. Okay. So like, get a grip. It's here. So what are you going to do? Take the opportunity to protect yourself and protect your money. Everybody on this call.
Yeah.
Yep.
Well said. Well, thank you so much, each of you. I would like to just share my screen, if you don't mind, to wrap up tonight. A huge round of applause for Aurelio, Marshall, and AJ. Thank you so much for sharing all of your unfiltered greatness and insights. And ladies and gentlemen, hopefully you can see my screen that says Market Leaders Lab. Yes? Yes. Okay, great. So thank you again to our panelists. And our next event is Wednesday, October 27th. It's a research lab. We are going to be talking about inflation. We are going to be talking about affordability. And I'm going to bring in some of those tips, Aurelio, about talking to the municipal clerks, about taxes, and some of the things that are going on there that we need to know about, as well as the Emergency Planning Act that has been instituted in Saskatchewan, Alberta, British Columbia, and I actually think, Marshall, I think it went in New York too, and but I'm not sure about that. So what that means, because a lot of folks are scared about what that means in terms of appropriating private property under it previously was the War Measures Act. So what does that mean? The Real Estate Wealth Lab, the real estate, I get excited here, REWL has contacted legal counsel to unpack what that Emergency Planning Act means. And we actually have some tactics and specific words that you can say in the event that something goes along there. And I want to unpack it a little bit more because it is a pretty terrifying concept, but we've gotten legal counsel on it and we're going to share that with you. So you definitely want to come out October 27th. And that's just the tip of the iceberg. There's more to come. And so this is why you need your free trial. Please join us for this journey, for our free trial for the rest of 2021. Again, you automatically get registered to all of our events, which we've got a number of them coming up. You will receive that real estate intelligence newsletter on a weekly basis with what it means. And again, I'm going to reiterate, I am getting far more uncensored and untethered and unapologetic and maybe a little sassy, but have fun with it, because there's a lot of real interesting economics that we just need to frickin' understand. So, and also you will have access to our members portal. So please join us, therealestatewealthlab.com/trial. And again, Aurelio, Marshall, Adrian, AJ, thank you so much for being here today. And for everybody for joining us for our very first Market Leaders Lab. Thank you.
Thank you. Bye, guys.
Bye-bye.
Bye.